Good afternoon and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the MarketSite in Times Square, we have Dan Muzzarelli. He is the vice president with LibraryShares ETFs. We also have Gragnani. He's the head of research and client engagement over at Nasdaq Dorsey, Wright. We're going to take a look at some risk factors within the market and ETF model portfolios. Thank you both so much for joining us at MarketSite. And Dan, let's kick it off with you. There was a lot going on in 2018, some volatility events that we were following. Let's talk about some of those and headlines that you're going to be looking at for 2019.
Certainly. It was a very tumultuous end to 2018. I think certainly clients had a lot to consider. When you take a look back now, kind of having gone through and looking at some of the green on the screen and to be able to take a breath, I think one of the things that advisors that I've been talking to and clients that I've been talking to have been focusing on is just concentration risk, right? If they look at their portfolios, a lot of the headlines that were coming out were whipping things around, but I think specifically in international equities, one of the things we're looking at is some of the unintended consequences of looking at concentrated portfolios.
All right, Jay, I'll ask the same question for you as well. Brexit, trade deals, inflated global government debt. Are you still hearing the same concerns from advisors?
Sure. I think those concerns are absolutely still out there with the uncertainty around Brexit, uncertainty around what's going to happen with the trade deals. I think everybody is optimistic that the trade talks are going to end in a good light, but still we don't know for sure, and I think there's still a lot of uncertainty around that. And I think that's ultimately in the fourth quarter what caused a lot of the volatility to pick up is that amount of uncertainty. And so as we're heading into 2019, what you're seeing now is the markets are snapping back. They're seemingly a little bit more resilient in 2019 from an international perspective. What you also had though last year is the negative impacts of the U.S. dollar. I mean, the U.S. dollar certainly provided headwinds for international equities by and large throughout 2018. The U.S. dollar had a strong 2018, and that provided a headwind for a lot of international equities. You're seeing that change around here a little bit as we head into 2019. If you look at some short-term charts on the U.S. dollar, that actually has moved back into a negative trend and potentially suggesting that the U.S. dollar will begin to pull back. What does that mean for international markets? That tends to shift that wind from being a headwind to being a tailwind for international markets, specifically in emerging markets. Emerging markets tend to do pretty well when you get into environments of falling dollar or weak U.S. dollar markets. So, we'll see. I think some of those political risks are certainly still out there, are still looming. We'll see how they get resolved, but right now what we're seeing is some positive action, positive trend movement from some of those international markets.
Right, it's really interesting because not much has really changed since the volatility that we saw, or the sell-off that we saw in December, with the exception of the dollar and of course the FOMC going back to more of a dovish stance. So how do advisors deal with all of these challenges and managing their portfolios when things really aren't that different since December, but the market would suggest otherwise?
Right, certainly, and that's exactly what I was alluding to before. I think the concentration that a lot of folks are experiencing in certain international parts of the world, if you look at a broad index, 51% and 53% respectively for developed and emerging markets in the broader indexes are comprised of just 3 countries. So I think a lot of the headlines have been pushing markets around insofar as Brexit certainly is one of them. China obviously is another, an example from DM and both from EM. So I think in terms of positioning, we've really taken a look at how folks are positioned, if they're correctly positioned for a lot of the volatility that we expect to continue. And in fact, kind of taking a step back and reminding folks that volatility is a good thing, right? This is the most volatile market that we've seen over the last, call it 10 years or so, save for 2015. But certainly with the volatility index picking back up and getting into more of a normal range historically, trying to decipher through some of those headlines, but certainly put it in the context of a portfolio setting and how clients make better decisions and sort of encapsulate that for client experiences.
Right, and I also think, particularly from the media perspective, just because a market sells off doesn't necessarily mean volatile. The two words don't correlate with each other. Selling off sometimes is a good thing. It's a reset of asset prices. If you stayed invested in December or you added to your portfolio, that was a good thing. So, Jay, we hear more ETF model portfolios are increasingly more popular with both of our businesses. Why is that? Does it help managers when these kinds of events happen?
Absolutely. ETF model portfolios is something that we've been building and constructing for many, many years. And, we continue to see growth in popularity in that, whether it be from broad tactical asset allocation solutions to more focused, more geared specific, whether it be country rotation or sector rotation ideas. But what model portfolios can do is help a portfolio manager, help an advisor provide scale to their business, number one, but then also help remove some of the emotional trades that may happen as a result of media overreaction maybe to some of the market environments. And what I mean by that, how it helps remove some of the emotion, is the way that we build portfolios and construct portfolios is they're completely systematic, they're completely rules-based. And we don't let emotions come into play when we're making decisions about which areas should be included in the portfolio and ultimately which areas should rotate out of the portfolio. Those are objective decisions that are based on the data that we're moving in and putting into our models. And so, model portfolios can have a tremendous impact and tremendous benefit from that perspective. What it can also do is provide a tremendous impact to opportunities that exist out there in the marketplace. So if you think about international markets for a second, no one international market is created equal. You mentioned China, you mentioned UK, and there's lots of different markets out there. And on any given year, the performance differential between the best and the worst performing country or market around the world can be huge. Just last year, over the past 2 years, that spread between the best and worst performing country was about 35 percentage points. And so what that means is there's a lot of opportunity to provide and find those countries, those areas of the markets that are doing well, and it also provides opportunity to identify trends that are simply not working in the marketplace and rotate those out of the portfolio.
Right now, how do these model portfolio work? Do they make the trades on one certain day of the week, or do they rely on certain triggers for these trades to get initiated?
Sure. So the way that we construct those, they're based simply on price momentum. And what we're looking at is we're comparing, for instance, I mentioned the countries, we'll compare a universe of countries to each other on a relative strength basis and just looking simply at the price momentum of those countries versus each other. And what we do is we simply rank those, top to bottom, strongest to weakest. And the goal of those models is to try and find and invest in the strongest trends that exist globally in the marketplace. And what we'll do is we'll come back and we'll evaluate those on a very systematic basis. Once a week, we'll go in and we'll evaluate to see if those countries remain amongst the strongest in the inventory. Once they fall out and hit our threshold, fall basically out of the top half of the rankings, once they no longer are able to outperform a majority of the universe that we're looking in, then we sell that country and we simply will replace it with the next highest ranking sector or country that's not currently in there.
So Dan, are you seeing more advisors adopt this practice within their management?
Absolutely. Obviously a natural partner for us working with Jay and his folks, and certainly as a deep value shop being Franklin Templeton and having a long and storied history of it. We really are excited to kind of continue on in that push. But I think the move to models has been slow and sort of a natural progression, I think, for a lot of advisory practices. And it's certainly something that I see with larger institutional clients as well, just kind of keeping more of a core asset allocation and then being able to sort of fill in gaps around it. But as Jay mentioned, I think, really the way that the market's kind of evolved and certainly where we are in the marketplace, as clients in general look towards, the opportunity set that's out there, I think volatility sort of gives you a dispersion of returns and gives you opportunity to encapsulate a better outcome for your portfolio when you have a huge 30% swath of the market, right, or a 30% difference in return streams that you're looking at as well. So certainly a concentration on specific portfolios and specific either factors or countries within those portfolios, but looking under the hood, taking kind of a holistic view from a portfolio perspective, I think is always healthy.
All right, and for 2019, what other ETF trends are you going to be watching?
Well, along the lines of models, certainly cost is obviously a factor, and it's going to continue to be a factor. If you look across the ETF marketplace, the most flows tend to go to the cheaper products. So I think in a portfolio, though, that looks at things from a broader perspective, you actually do have room to look at things that are potentially more expensive than just a couple of basis points as well, and spreading out that cost. Certainly from the perspective of a provider, looking at active ETFs is another thing that we've seen pick up. In fact, by the end of last year, active ETFs accounted for almost 5% of revenues from ETF providers. So we expect that to continue on the way up. And then the other thing, it's kind of an old story at this point because it's been a couple of years, but smart beta, right? From a strategic perspective, I think we kept talking about volatility and what this was built for, and now we get to actually have a period of volatility that we can point back to, say that this may actually continue in the future, and then look at which products and fared well during that time period and what they were built for and how they worked in the context of a portfolio.
All right, thank you both for joining us at MarketSite, and we'll see you at Inside ETFs. And thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.